welcome to Sectors Up Close. I'm Elena Casas. Today we're talking media and communications, and my guest is Amy Kong, CIO of Barrett Asset Management. In the past, media has been one of the first sectors to suffer when the economy heads towards recession, as people cut back on subscriptions and advertising revenues start to dry up. We've seen some early signs of that from Netflix this year. Billions of dollars were wiped off its market cap in the spring when it admitted losing subscribers. But if they're the losers in the streaming wars so far, Disney seem to be the winners, as its subscriber numbers keep on going up. The S&P communications sector, though, tracked by the XLC ETF, is dominated by two companies that are more tech than traditional media. Google parent Alphabet and Facebook owner Meta Platforms today represent 41% of its holdings, and they've told two quite different stories this year, with Google's YouTube dominating online video, while Facebook and Instagram seem to be going terminally out of fashion. XLC then is down 32% year to date, with that 56% slump in Meta Platforms being the biggest drag. So, as financial conditions tighten, where does the sector stand? Let's ask Amy Kong, CIO of Barrett Asset Management. Amy, hi. As I was saying, in previous recessions, media and particularly advertising-dominant companies, which of course Google and Facebook still are, have been where we've seen some of the suffering most quickly. Is that still true, or are they becoming more defensive now?
Hi, Elena. Thanks for having me. I think it's still true. When you look at the communications sector, it used to be dominated by the wireless carriers. And the idea is if a recession were to hit, the last thing you'd cancel is your cell phone. Now, with the inclusion of the Metas and the Alphabets of the world, that cyclicality aspect is really becoming more apparent because a lot of these companies are very dependent on ad sales. And typically in a recessionary environment, you do see a bit of a wavering effect, if you would, on ad sales. And so that, again, probably helps to lower the defensive characteristic of the overall sector. I think what's also important to realize, too, is within the wireless carrier space, as well as in the streaming, to your point, we're starting to see some price wars. And I think that also, unfortunately, does not help, the defensive characteristic of the sector. What I would say, though, is that the Googles and the Metas, what they do is they help a little bit from a leverage standpoint because they're in a net cash position, whereas some of these other wireless carriers are sitting on nearly $200 billion of debt.
As we were saying, though, Google and Meta, the two huge companies here, have seen quite different pictures in their stock price this year. How do they compare to one another?
Google is a little bit more structured in the sense that, to your point, there's the YouTubes of the world, there's the search engine, which is really a core foundation for them and should actually be protective even in a recessionary environment. Meta is a different situation because they are really reliant on ad sales when it comes to what makes up their revenue stream. And so clearly when you see the ad sales portion decline, that's a reflection of why Meta's stock price has not done as well.
What about the streaming wars then? We've heard a lot this year about Netflix versus Disney. How do you think all the different companies in the streaming space are positioned looking forward?
Sure. As I've mentioned, there is a little bit of a war going on in the streaming space as well. How many, subscriptions does one need, especially in a post-pandemic world? I think between Disney and Netflix, our perspective is that Disney is in a better position for a couple of reasons. First of all, it's important to realize that Disney is still very early when it comes to its streaming business versus Netflix has been around for a lot longer and they're more mature. Disney actually just released Disney Plus in over 55 countries. So they're just beginning to get exposure in over 150 regions around the world. Of course, Disney also has other aspects in their business model to offset in case Disney Plus continues to stay unprofitable, and that's the parks and there's products and there's a lot of things going on that can help offset. And then finally, content is king in this kind of industry, and I think Disney is in a slightly better position. They have just a very strong foundation when it comes to creating content and being able to successfully distribute that across the many channels that they have. So I think even though there is a streaming war going on, I think the Disney story, in our opinion, remains robust.
As we head then to a much tighter fiscal environment, Amy, how should investors be approaching this sector?
As I've mentioned, I think the ability to really decipher against the wireless carriers and the entertainment names, I think is very important. One thing to also be mindful of is that the entire sector, although there are 30 to 40 different names in the sector, Google and Meta actually make up more than 50% of the earnings. So I think that's a concentration risk that investors need to be very mindful of. And again, the ad component is important because you have a company like Meta that's 100% or nearly 100% in ads versus a Google that have other things to offset. I think investors should think about that when they think through how diversified and how defensive they want their portfolio to be over the next quarters.
Well, thanks so much for joining us, Amy Kong, CIO of Barrett Asset Management. Well, that's our look at the media and communications sector. I'm Milena Casas, and this is Reuters.